The boardroom on the 35th floor of ExxonMobil's headquarters in Irving, Texas, held the quiet confidence of decades of global operations. In late 2006, executives reviewed quarterly reports from Venezuela's Cerro Negro project, where the company held a controlling stake in one of the world's largest heavy oil ventures. Production figures showed steady output from the Orinoco Belt, where ExxonMobil had invested over $750 million since 2001. The Venezuelan operations generated substantial revenue streams, contributing to the corporation's position as the world's largest publicly traded oil company. Regional managers delivered presentations highlighting expansion possibilities and long-term extraction projections. The atmosphere reflected institutional certainty built on contractual agreements and established precedent in international oil partnerships. ExxonMobil's presence in Venezuela stretched back to the 1920s, when the company operated under different corporate structures in a nation that had become synonymous with oil wealth. By the 1990s, Venezuela's government actively courted international oil companies to develop its vast heavy oil reserves in the Orinoco Belt. The deposits represented one of the world's largest petroleum reserves, but extraction required technological expertise and capital investment beyond the capacity of the state oil company, Petróleos de Venezuela S.A., PDVSA. The Cerro Negro project emerged from this context. ExxonMobil entered a joint venture in 2001, holding a 41.67% stake alongside PDVSA's 38.33% and other international partners including BP, Statoil, and Veba Oil. The partnership operated under a profit-sharing agreement that granted foreign companies significant operational control while providing Venezuela with substantial revenue through taxes and royalties. The venture processed approximately 120,000 barrels per day of heavy crude, upgrading it into synthetic crude oil suitable for international markets. The investment represented more than financial commitment. ExxonMobil transferred advanced extraction and processing technologies, trained local personnel, and established supply chains connecting Venezuelan production to global markets. The company's executives viewed the operation through the lens of long-term strategic planning, anticipating decades of profitable extraction. Venezuelan officials, meanwhile, positioned the partnerships as essential for developing reserves that required foreign expertise and capital to reach commercial viability. Regional political stability appeared solid through the early 2000s. Venezuela maintained democratic institutions, honored existing contracts, and provided predictable regulatory frameworks for international investment. The nation's oil sector operated according to established international practices, with foreign companies maintaining operational control over their investments while sharing profits with the Venezuelan state. Hugo Chavez assumed Venezuela's presidency in 1999, representing a coalition that had emerged from decades of economic inequality and political corruption. His initial policies focused on constitutional reform and social programs funded by oil revenues while maintaining existing arrangements with international oil companies. The global oil market experienced rising prices during his early presidency, increasing Venezuela's petroleum revenues and providing fiscal space for expanded government spending. Chavez's administration initially signaled continuity with established oil policies. Government officials met regularly with international companies, discussing expansion projects and new investment opportunities. PDVSA maintained its partnerships with foreign corporations, and existing contracts remained in effect. The president's early speeches emphasized Venezuela's reliability as an energy supplier and the nation's commitment to honoring international agreements. However, the political coalition supporting Chavez represented constituencies that had historically been excluded from Venezuela's oil wealth. These groups viewed foreign oil companies as beneficiaries of arrangements that provided insufficient returns to the Venezuelan people. The president's rhetoric gradually incorporated themes of resource nationalism, questioning whether existing contracts adequately served Venezuelan interests. The administration began asserting greater state control over oil policy through a series of incremental measures. New regulations increased royalty rates and tax obligations for foreign companies. Government officials initiated reviews of existing contracts, examining profit-sharing arrangements and operational procedures. PDVSA expanded its management presence in joint ventures, appointing additional personnel to oversight positions. International oil companies adapted to these changes, viewing them as normal adjustments to fiscal terms that occurred periodically in resource-rich nations. ExxonMobil's executives calculated that Venezuela's oil reserves justified accepting higher costs, particularly given rising global petroleum prices. The company continued investing in Venezuelan operations and maintained positive relationships with government officials responsible for oil policy. By 2005, global oil prices had reached levels not seen since the 1970s, driven by growing demand from emerging economies and concerns about supply disruptions in key producing regions. Venezuela's oil revenues increased dramatically, providing the Chavez administration with unprecedented fiscal resources. The government launched ambitious social programs, expanded public sector employment, and increased subsidies for basic goods and services. Rising oil prices also altered the economic dynamics of Venezuela's partnerships with international companies. The profit-sharing agreements negotiated during the 1990s had been structured around lower price assumptions, meaning foreign companies captured substantial windfall profits as petroleum values increased. Venezuelan officials began calculating that the nation could capture greater revenue by assuming direct control over oil operations. Chavez's administration commissioned studies examining the financial terms of existing oil contracts. Government economists concluded that Venezuela received a smaller share of total oil revenues compared to other major producing nations. The analysis suggested that renegotiating or terminating existing agreements could significantly increase state income from petroleum exports. The political environment also influenced government calculations. Chavez faced increasing opposition from domestic groups aligned with international business interests, including elements within PDVSA's traditional management structure. Asserting greater state control over oil operations provided an opportunity to consolidate political power while demonstrating commitment to resource nationalism. International legal considerations appeared manageable from the Venezuelan government's perspective. The nation's constitution asserted state sovereignty over natural resources, and newly elected officials argued that previous administrations had negotiated agreements that violated constitutional principles. Government lawyers maintained that Venezuela possessed legal authority to modify or terminate contracts that conflicted with national sovereignty. Regional political developments also supported more assertive oil policies. Other Latin American governments, including Bolivia and Ecuador, were implementing similar resource nationalist policies, creating a broader context of state assertion over natural resources. These precedents suggested that international companies had limited recourse when governments decided to renegotiate or terminate existing agreements. On May 1, 2007, President Chavez announced that Venezuela would assume majority control of oil projects in the Orinoco Belt. The decision affected 4 heavy oil ventures, including ExxonMobil's Cerro Negro project. Government officials stated that foreign companies could maintain minority stakes in restructured partnerships, but PDVSA would hold controlling interests in all operations. The announcement followed established Venezuelan legal procedures. The National Assembly had previously passed legislation authorizing the government to convert existing profit-sharing agreements into joint ventures with state majority control. Constitutional provisions asserting state sovereignty over natural resources provided legal justification for the policy change. Government lawyers argued that the measure represented legitimate exercise of national sovereignty rather than arbitrary expropriation. Venezuelan officials presented the decision as a business proposition rather than hostile action against foreign investment. The government offered to negotiate compensation for assets transferred to state control and invited international companies to participate as minority partners in restructured ventures. Officials emphasized that the policy aimed to increase Venezuelan control over domestic resources while maintaining beneficial relationships with international partners. 3 of the 4 affected companies, BP, Statoil, and Chevron, entered negotiations with Venezuelan authorities to restructure their partnerships according to the new requirements. These companies calculated that maintaining minority stakes in Venezuelan operations remained profitable despite reduced control and ownership shares. The negotiations proceeded through established diplomatic and commercial channels. ExxonMobil adopted a different approach. Company executives determined that accepting minority status in Venezuelan operations would set adverse precedents for other international investments. The corporation's legal team argued that Venezuela's action constituted expropriation under international law, violating bilateral investment treaties and established legal protections for foreign investment. ExxonMobil announced its intention to pursue international arbitration rather than negotiate restructured partnership terms. ExxonMobil's decision to reject Venezuelan partnership terms reflected corporate strategy extending beyond immediate financial calculations. The company operated in numerous countries where governments periodically modified fiscal terms or asserted greater control over oil operations. Executives worried that accepting Venezuelan terms would encourage other governments to implement similar policies, potentially affecting ExxonMobil's global investment portfolio. The corporation initiated legal proceedings in multiple jurisdictions, seeking to protect its Venezuelan assets and obtain compensation for losses resulting from government action. ExxonMobil filed cases in United States courts, obtained asset freezes affecting Venezuelan property in several countries, and commenced arbitration proceedings under international investment treaties. The legal strategy aimed to impose costs on Venezuela while establishing precedents protecting foreign investment rights. Venezuelan officials responded by accelerating the transfer of ExxonMobil's assets to state control. PDVSA assumed operational control of the Cerro Negro project, appointing new management and integrating the facility into state-controlled operations. Government officials characterized ExxonMobil's legal actions as attempts to undermine Venezuelan sovereignty and interfere with legitimate government policies. The dispute extended beyond bilateral relations between ExxonMobil and Venezuela. Other international oil companies monitored the conflict, assessing implications for their own investments in countries implementing resource nationalist policies. The case became a test of international legal mechanisms designed to protect foreign investment against government action. Financial markets also tracked the dispute's progression. ExxonMobil's stock price incorporated uncertainty about the company's ability to recover Venezuelan assets or obtain adequate compensation. Venezuelan government bonds reflected investor concerns about the nation's treatment of foreign investment and potential impacts on future capital flows. The immediate financial impact on ExxonMobil appeared manageable within the context of the corporation's global operations. Venezuelan assets represented a small percentage of total company value, and rising global oil prices increased profitability from other investments. However, the dispute created precedents that extended beyond immediate financial calculations. Other governments observed Venezuela's successful assertion of control over international oil investments. Bolivia implemented similar policies affecting natural gas operations. Ecuador renegotiated contracts with foreign oil companies. Argentina later applied comparable measures to foreign investments in various sectors. The Venezuelan case demonstrated that governments could modify or terminate existing agreements with international companies, despite legal protections and treaty obligations. The arbitration proceedings initiated by ExxonMobil proceeded through established international legal mechanisms. The International Center for Settlement of Investment Disputes, ICSID, operating under World Bank auspices, provided a forum for resolving disputes between foreign investors and sovereign governments. However, the arbitration process required several years to reach conclusions, during which Venezuela maintained control over disputed assets. Venezuelan oil production continued under state management, though operational efficiency declined from levels achieved under international company management. PDVSA assumed responsibility for facilities previously operated by foreign companies, but lacked the technical expertise and capital resources to maintain optimal production levels. The nation's overall oil output gradually decreased, despite possessing some of the world's largest petroleum reserves. The legal proceedings also imposed costs on both parties. ExxonMobil devoted substantial resources to international arbitration and litigation across multiple jurisdictions. Venezuela allocated government resources to legal defense, while facing asset freezes affecting official property in several countries. The dispute consumed diplomatic attention and complicated Venezuela's relationships with other international partners. In 2012, an ICSID tribunal issued its initial award in the ExxonMobil case, determining that Venezuela owed compensation of approximately $255 million for commercial assets transferred to state control. The amount fell far below ExxonMobil's claimed losses, which the company calculated at several billion dollars. Venezuelan officials characterized the award as vindication of their legal position, while ExxonMobil appealed aspects of the decision. A second arbitration proceeding under different legal arrangements continued simultaneously. In 2014, another ICSID tribunal awarded ExxonMobil approximately $1.6 billion in compensation for the Cerro Negro project. However, this award was subject to set-off against amounts Venezuela claimed ExxonMobil owed under separate contractual arrangements. The complex legal structure meant that neither party achieved clear resolution of their dispute. Venezuela's payment of arbitration awards remained inconsistent due to the nation's deteriorating fiscal position. Declining oil prices after 2014 severely reduced government revenues, while economic mismanagement created broader financial crises. The country faced difficulty meeting obligations to international creditors, including arbitration awards to foreign companies. ExxonMobil encountered practical challenges collecting compensation despite favorable legal decisions. The broader implications of Venezuela's oil policy became apparent over subsequent years. International investment in Venezuelan oil operations declined sharply as companies reassessed political risks associated with government policy changes. The nation's oil production fell from approximately 3 million barrels per day in 2007 to less than 1 million barrels per day by 2020, reflecting both economic sanctions and operational difficulties under state management. Other oil-producing nations modified their approaches to foreign investment relationships, incorporating lessons from Venezuela's experience. Some governments implemented gradual changes to fiscal terms while maintaining operational stability. Others adopted more aggressive resource nationalist policies despite potential costs in terms of foreign investment and technical expertise. The ExxonMobil case established precedents affecting international investment relationships between multinational corporations and resource-rich governments. The dispute demonstrated that legal protections for foreign investment, while significant, did not prevent sovereign governments from asserting control over domestic resources when political incentives supported such actions. International arbitration mechanisms provided forums for resolving investment disputes, but required years to reach conclusions and did not guarantee effective enforcement of awards. Governments with strong political motivation to assert resource control could implement policies despite potential legal consequences, particularly when global commodity prices provided alternative sources of fiscal revenue. The case also illustrated how corporate responses to government policy changes could influence outcomes. Companies that negotiated with Venezuelan authorities maintained operational presence and continued generating revenue, albeit under modified terms. ExxonMobil's decision to pursue legal remedies rather than negotiate operational arrangements resulted in complete loss of Venezuelan assets, despite eventual arbitration awards that proved difficult to collect. Subsequent events demonstrated the long-term costs of resource nationalist policies for Venezuela's oil sector. The nation's petroleum production declined dramatically under state management, reducing government revenues and contributing to broader economic crisis. However, these consequences emerged over years and decades, while the immediate political benefits of asserting state control over oil operations appeared more substantial to government decision-makers. The dispute revealed fundamental tensions between corporate property rights and national sovereignty over natural resources. International legal frameworks attempted to balance these competing principles through investment treaties and arbitration mechanisms, but political pressures within resource-rich nations often supported policies that conflicted with foreign investor interests. ExxonMobil's Venezuelan operations had been structured around assumptions of contractual stability and predictable regulatory frameworks that characterized international oil investments during the 1990s. The company's executives calculated risks and returns based on historical precedents and established legal protections for foreign investment. These calculations did not adequately account for political changes that could fundamentally alter the investment environment. Venezuela's decision to assert majority control over oil operations reflected domestic political pressures and changing global commodity markets that increased the fiscal value of petroleum resources. Government officials calculated that benefits of increased state control over oil revenues outweighed potential costs in terms of international legal disputes and reduced foreign investment. The arbitration awards eventually obtained by ExxonMobil validated the company's legal arguments about Venezuelan treaty violations, but practical enforcement remained problematic due to Venezuela's subsequent economic difficulties. The corporation recovered a fraction of its claimed losses through legal proceedings that extended over more than a decade. International oil companies operating in other countries incorporated lessons from the Venezuelan experience into their investment calculations. Risk assessment procedures expanded to account for political changes that could affect contractual arrangements and operational control. Some companies adjusted their global investment strategies to reduce exposure to countries with higher political risk profiles. Venezuelan oil production never recovered to levels achieved during the partnership period with international companies. The nation's petroleum sector experienced operational difficulties, technological limitations, and reduced investment that contributed to long-term production declines. These consequences affected Venezuelan fiscal revenues and contributed to broader economic problems that persisted for years. The case established precedents for subsequent disputes between international oil companies and resource-rich governments implementing nationalist policies. Similar conflicts emerged in other countries and sectors, with arbitration tribunals applying principles developed through the Venezuelan cases to new investment disputes. The ExxonMobil arbitration awards remain partially unpaid, with Venezuela continuing to dispute aspects of the decisions while facing broader difficulties meeting international financial obligations. The unresolved nature of the dispute reflects continuing tensions between corporate property rights and national sovereignty over natural resources. Recent developments in Venezuela's oil sector have created new complexities around international investment relationships. United States economic sanctions imposed after 2017 restrict foreign company operations in Venezuelan oil facilities, creating additional legal and practical obstacles to resolving historical disputes and establishing new investment arrangements. The decision that triggered ExxonMobil's exit from Venezuela continues to influence international investment relationships in resource-rich developing nations. Governments and corporations negotiate partnerships against the background of precedents established through the Venezuelan case, while arbitration tribunals apply legal principles developed through years of complex proceedings. In the context of global energy transitions and changing commodity markets, the long-term consequences of Venezuela's 2007 oil policy decisions extend beyond bilateral relationships between specific companies and the Venezuelan government. The case represents broader questions about how nations balance resource sovereignty with international investment relationships in an interconnected global economy.